Hello class, this is Dr. Fenton. In this video, we're going to cover Chapter 2 of Managerial Accounting. This chapter talks about job order costing, so we're going to find the total cost of a job as it's being produced and finished, and then we're going to calculate the unit cost for the units produced within that job. So let's get started. Companies must find the cost of their products and services. A manufacturing company needs to know how much the items cost that it's manufacturing because it needs to know how much it needs to price these products for to make a profit, to have a good bottom line figure. The same can be said for service industries, accounting firms, law firms, and so forth. They have jobs that consist of clients. How many hours are you spending on a client's work? Are you having to do extra research, or you have more materials, more copying or whatever for a certain job. So, you need to find out how much an item is costing you so that you know how to price it, and you need to price it enough so that you can pay for all of your other operating expenses, because you would like to have a positive net income figure at the end of the year. Now, we have a lot of terms in this chapter as well, just like the first chapter, and the first one here popping up is absorption costing. And this just says that all the manufacturing costs, both fixed and variable, are assigned to the units of a product. So the units fully absorb the manufacturing cost. So when we talk about jobs here in a minute, you can see job order costing at the bottom of the page. When you have a job being produced, you need to assign all the materials, all the labor, and all the overhead, both fixed and variable, to that job. So this gets you the complete cost of that job, that item being produced. Now for job order costing, this costing system is used when you're making different kinds of products. Now a job can consist of maybe making 100 units of a certain item, and that certain item, that certain product will have different materials and labor costs compared to other products that you're producing. And so a job can be, one item, like one house could be one job. So you have all the materials going in there, all the labor and so forth into that one job. Or a job could consist of, like the example here in the book, 1,000 jeans of a certain style. The style number A312 on these jeans will need a certain amount of material per jean, a certain amount of, snaps or zippers or decoration or whatever. And you could make 1,000 of these in one production run, and that'll be one job. So one job can be a number of units of the same item you're producing, or it could be one large item like a house or even an office building. So whatever your job is, we're going to see here in the next page, you need to find out what costs are involved in making that job, that specific job. You have other items in here. We have Bechtel International. They're a large-scale construction company. They built airports around the world, buildings around the world, and so forth. And so when they build, let's say, a new airport somewhere, they keep up with that job, that airport, all the materials, all the labor, and all the overhead that needs to be assigned to that job. Let's look at the next page. Job order costing. Now this is a long, detailed example. We jump right into it. So make sure you go back and read this after you look at the video and follow all the numbers through and read every word on these several pages here. Now they first start talking about a materials requisition form. You don't have to memorize this form. You need to know what it is. And like the definition here says, you can pop this window out, it's a document that specifies the type and quantity of materials to be drawn from the storeroom, and that identifies the job that will be charged for the cost of those materials. Well, what does that mean? All right, you have a job that's getting started out in the production process, out on the factory floor. You need materials for that job. And so you need to requisition the materials, and companies will have forms for this. What materials do you need? How much of the wood, plastic, steel, whatever do you need for that job? So you fill out this requisition form, send it to the materials warehouse, really, where they have materials inventory, and then those will be moved over from the warehouse to the factory floor, And when that happens, the accounting will also take place. You're going to end up debiting, you talk about journal entries, you're going to end up debiting work in process inventory, because you saw in the last chapter, the work in process inventory account is the account that's used to accumulate all production cost. So when you requisition materials, when materials are moved from the raw materials warehouse to the factory floor, not only do the units physically move from one place to the other, but the accounting cost also in the books move from one place to the other. You will debit work in process inventory, and then you will credit raw materials inventory. This shows you the number of units of raw material that you need and the exact description of what those raw materials are. Cost per unit, multiply, and here's the total cost. Okay, so you're going to transfer $660 of materials to the factory floor, and these are the materials. You need 2 housings and 4 connectors. The next form we have is called the job cost sheet. I want you to pay close attention to this sheet and make sure you know what goes into this form. So here it is. We first start out with a job number, and each company has its own series of job numbers, so this is not really important overall, but this company happens to call this job number 2B47. It shows the department in which the manufacturing process is occurring. In this case, it's the milling department. Then it describes the item that we are producing. This is a special order coupling. So a customer must have needed some kind of coupling, some kind of special design. So this is what we're going to use to accumulate the cost for this special order. Of course, we have the date initiated, and then we have a couple other items information. Date completed when that occurs, and the number of units completed when we know that. Over here on the left, we show the materials we just talked about being accumulated on the job cost sheet. So we had $660 worth of materials. So you put in here the requisition number. Let me back up. Here's the requisition number. Here's the cost of these materials transferred to the factory floor. So there's the number and the cost. And we will, when we add more materials, we'll add more cost to this. When you incur direct labor, you keep up with the time ticket, the number of hours that person worked on this job, and the cost for this labor that we charged to this job. We'll also accumulate the manufacturing overhead over here. We'll see that in a few minutes. And we'll see this completed in just a few minutes as well. Now, direct labor. As you know, direct labor means those labor costs or labor charges that can be easily traced to a particular job. So in this case, we have a time ticket completed by an employee. And so here's this employee's time ticket. And we can see that they worked from 7 to 12, 5 hours, and we charge a rate of $18 per hour to a job when this person works on it. And so that adds up to $90. So 5 times 18, $90. And this person worked on the same job we were talking about on the job cost sheet, job 2B47. Now, the same employee worked on other jobs and maintenance, but these costs here are not charged to this one job. Another example here is $36 will be charged to job 2B50. We don't have the job cost sheet for it, so don't worry about that. This is just showing you that you keep up with Mary Holden's time ticket, and she will enter the time, the hours that she worked on a particular job, and then we will charge that job with that cost. So here's the $90. I'll go back up. We placed it into here, 5 hours at $90. And there's the ticket number, the time ticket number. So far we've talked about materials and labor. So let's go further. Now, predetermined overhead rates. Now this is quite detailed, and so go back and reread this very, very closely. Now, absorption costing includes materials and labor, and also the manufacturing overhead. And as you remember, manufacturing overhead is an indirect cost. It includes all other manufacturing costs except for direct materials and direct labor. Everything else, it can be the rent or depreciation on the factory building, the equipment, the utilities, insurance on the building equipment, supervisor salaries, many, many things go under manufacturing overhead. But we have to figure out some way to attach those indirect costs to these jobs we're working on. It's easy for the materials. We have the materials requisition form. It's easy for the labor. We have the time tickets. So we can assign with great accuracy materials and direct labor to a job. But overhead, that's a different story. We cannot assign it directly when we incur a specific cost to a specific job because these relate to so many jobs. So what we need to do then is estimate the overhead. And we come up with what's called a predetermined overhead rate. Right here, predetermined overhead rate. And it's computed by dividing the total estimated manufacturing overhead cost for the period, usually a year, by the number of units in the allocation base. This could be hours, it could be units or whatever. But here's the formula down here. So we're going to estimate total manufacturing overhead cost, and I'll go ahead and add for the whole year. And we're going to divide by the estimated total amount of the allocation base. And again, it could be machine hours or direct labor cost or something like that. So we're going to compute this overhead rate before the period begins, and usually we do it at the first of the year and use the same rate for all jobs throughout the year. The first thing to do is to add up all the manufactured overhead cost. We're going to have some that's fixed. We're going to have some that's variable, based on a certain unit allocation base. And so here's the formula again. The total manufacturing cost, overhead cost, will equal the fixed manufacturing cost plus the variable manufacturing cost that we estimate at a certain activity level. Again, this is very detailed, so pay close attention and go back and reread it. Now here we're going to have a formula that shows how we apply overhead to a particular job, to that job cost sheet. We are going to use that predetermined overhead rate, and again, this could be the amount per hour, per dollar amount of direct labor cost, per machine hour, whatever, times the number of that allocation base, the number of units of the allocation base that we're using for the overhead. So with some numbers here, let's go through this with numbers. The company estimates it's going to have 40,000 direct labor hours for the whole year coming up. And we estimate that $640,000 of total fixed manufacturing cost will be incurred, plus $4 of variable manufacturing overhead cost per direct labor hour. So if we think that we're going to have $4 of variable manufacturing overhead cost per hour, and we estimate 40,000 hours, then we're just going to multiply those two together, and that'll be $160,000 right here. Then we'll add that to the fixed portion, and our total estimated, this is an estimate now, our total estimated manufacturing cost for the year coming up is $800,000. This is an estimate. We decided, to use direct labor hours as that allocation base. And so if we estimate $800,000 for the year coming up in total manufacturing overhead cost, and we estimate 40,000 direct labor hours, just divide, that means our predetermined manufacturing overhead rate is $20 per direct labor hour. What does this mean? That means for every direct labor hour we have for a job, we're going to add to that job overhead at the rate of $20 per direct labor hour. Now we're going to directly add materials and labor, direct labor, and then we're going to use direct labor hours to apply overhead. So if we get down to the end after this job is completed, if we have all these material costs, we've added more materials as it was worked on, we have all these labor hours, and they get to 27 when we're finished with the job, then we're going to take this number, 27, drop it in here, and then take that times $20 per direct labor hour. So 27 hours times $20 per hour is $540 we're applying to this job for the manufacturing overhead. So when you look at this job cost sheet, we have the actual materials being used and their actual cost. We have the actual direct labor being used and the cost that we use to apply it. These are actual numbers. Then we have an estimated rate of $20 per hour times the actual direct labor hours, but this is a predetermined rate, and so we estimate and apply $540 to this job for manufacturing overhead. To complete this job cost sheet, we take these costs, materials, labor, overhead, from here, here, and here, add them up. Our total product cost then is $2,390. So this $2,390 includes materials, labor, and overhead. They're all added. If this is, for this job, only 2 units completed, then we'll divide the $2,390 by 2 and get $1,195 per unit. Here's the computation here. $2,390 divided by 2 units. So per unit, it's $1,195. These couple of paragraphs explain why we need to have that predetermined overhead rate. And that's because we want to smooth out these overhead costs on jobs being worked all throughout the year. Now, if we tried to apply overhead directly, like weekly or monthly, then you're going to have some months that have a very high overhead cost for that month. Like in the winter months, your factory building might have a large heating bill. In the summer, maybe a large cooling bill for air conditioning. But maybe in the springtime and the fall time, then you're not going to have much in utilities. So if we try to apply the actual cost even per month, you're going to have the overhead rate being high in some months, low in other months, and it's just going to be too much to keep up with. So the best thing to do is estimate it for the whole year instead of having those peaks and those valleys when you're trying to estimate overhead depending on what time of the year it is. Okay, so let's go to the next page. This page shows you why we need to have an accurate job order costing system. Now, managers use job cost information to establish plans and make decisions. How much in raw materials should they purchase? How much do they need to use? How much labor do they need to hire, for an upcoming year or season or whatever? So you need information that's going to be accurate. You also need it for pricing decisions. How much will the product cost you? Then you need to know then, after that, what should you price it for so you can sell it and make a profit to pay for your selling and administrative expenses. So they need to be accurate. If a job costing system does not accurately assign manufacturing costs to jobs, it will adversely influence the types of planning and decision-making scenarios just described. We also need to choose an allocation base. How do we apply the overhead? This is a good little example you can read. It talks about some friends eating pizza. And if one person eats a lot more slices of the pizza than the other people, then maybe that person should pay more of the bill, right? So read that paragraph. And then down here it talks about manufacturing again. A lot of companies use labor hours to apply overhead. We did that in the previous page. But if that is not the best allocation base to use, you need to use what is best. It could be machine hours. It could be something else. So, some companies use a plant-wide overhead rate. So they might use direct labor hours for every department in the company. Is that accurate? Hopefully it is, but it might not be. So, going back to the allocation base, now direct labor hours might indeed drive some of the overhead cost for certain departments. You might have other departments that maybe should use machine hours or some other kind of allocation base. And also, within a company, if there's more than one overhead cost driver, they need to use different cost drivers, even within a department or in between departments, to come up with a multiple predetermined overhead rate system. Now, what this is saying is that a company, to be as accurate as possible, needs to look department by department and see which is the factor in that department that drives the overhead cost. Is it direct labor hours? Is it machine hours? Is it something else? And then department by department, the more closely you can tie these costs to what's driving those costs, the better numbers you're going to have in the accounting system. Now let's go through an example where we do actually use multiple predetermined overhead rates. In this example, we're going to see that this company out in the factory has two departments. We have the milling department and then the assembly department. And the products go from one department to the other, and then they're finished. In the milling department, we're going to use machine hours as our predetermined overhead allocation base. And in the assembly department, we're going to use direct labor hours. So this information shows us that we estimate for the year coming up that we're going to use 60,000 machine hours in total for the whole year. In assembly, we're going to have 3,000 machine hours. Direct labor hours will be 8,000 in milling and 80,000 in assembly. So since you can see that in the milling department, it's so heavily weighted towards using the machines, we're going to use machine hours for the allocation base. In assembly, we have a lot more hours allocated towards direct labor than machine hours, so that's why they decided to use labor hours for the allocation base. They also estimate the fixed cost will be $390 for milling, $500 for assembly. This is overhead cost, of course. And the variable overhead rate will be $2 per machine hour for milling and $3.75 per direct labor hour for assembly. We have job number 407. We use 90 machine hours in milling, 5 hours direct labor and direct material cost, $870, all for milling. Now when that job was then moved over to the assembly, we had 4 machine hours, 20 direct labor hours, direct labor cost, add some more, $370, and the direct labor cost, $280. So let's take all this information and come up with how much should we apply for overhead to job number 407. We have a 5-step process, they say. So here's sort of a busy schedule here, so let's work through it step by step. First of all, step 1. We need to calculate the estimated total manufacturing overhead cost for each department. For milling, the fixed cost is $390, the variable cost is $2 per machine hour, and they already estimated this for us ahead of time. We estimate 60,000 machine hours for this department. So $2 times 60,000, $120,000. Add that to the $390 fixed, and so the total manufacturing overhead cost for the milling department, the milling department only, is $510,000. Now do the same thing for the assembly department. We estimated fixed cost for the year $500,000. We estimated $375 per direct labor hour, and we estimated 80,000 direct labor hours for the year. So now to multiply $375 by 80,000, $300,000 for variable cost, $500 fixed, and so our total manufacturing overhead cost for the assembly department is $800,000. Now, find the rate for each department. In milling, we take the $510,000, and these numbers are getting quite small here, but this formula here is $510,000 divided by 60,000 machine hours. So again, if you can't quite see this, this is $510,000 from step 1 for the milling, divided by the estimated hours for machine hours, 60,000, so $8.50 per machine hour. So every job that comes to the milling department, when there is 1 machine hour spent on that job, you're going to add $8.50 per machine hour for overhead. Okay. For assembly, similar. Take the $800,000 total assembly overhead cost, $800,000 divided by the direct labor hours, not machine hours here, direct labor hours. And so the $800,000 divided by 80,000 direct labor hours gives us $10 per direct labor hour as our overhead rate. This is for the assembly department. So now as job 407 goes through these departments, if we use 90 machine hours for job number 407 in the milling department, we take the 90 machine hours times our rate of $8.50 per hour. So we're going to add $765 to job 407 for overhead in the milling department. Then as it's transferred to the assembly department, you look and see how many direct labor hours were used for this job. We used 20 hours of direct labor for this one job, job 407. Our rate is $10 per hour, so it's $200 we're going to add to this job in the assembly department for overhead. So putting it all together, and they give us these material and labor numbers earlier. Let me show you right in here. Okay. Come back down. Direct labor, milling, 800. Direct materials, 800 for milling. Direct labor, 70. And now bring the 765 down for the manufacturing. Assembly, take its materials, its labor, and then add its overhead we just computed. Add across, add down. So the total cost of job 407 is $2,485. Now think about it. That $2,485 includes the materials we added in milling, the labor we used in milling, and we applied overhead in the milling department. It also includes the materials we added in assembly, the labor we used in assembly, and the overhead we applied for the assembly department. So a total of $2,485. Now if we mark up to get a selling price, if we mark it up 75% above cost, we just found the cost, $2,485, and add 75% of $2,485. 75% of the cost. That's going to be our markup, $1,863.75. And so the selling price of this job is going to be $4,348.75. So this job cost us to make $2,485. We added some profit in here, 75% of the cost, and so the selling price to the customer will be the $4,348.75. So I know this is a lot of information here, a lot of detail. What we're doing is for each department separately, finding the overhead rate for each department. In milling, this overhead rate was based on machine hours. In assembly, based on direct labor hours. Then we find out how much in overhead costs we should add to each department. In milling, take the machine hours for the job you're looking at, times the rate, and do the same thing for assembly. Direct labor hours times the rate. And this is what we just talked about here. All right, next page. Since we are using an estimate to apply overhead, then when we get down to the end of the year, we're not going to be accurate down to the penny or to the dollar on our estimate compared to what we actually applied to the jobs worked on during that period. So we're going to have usually some under or over applied overhead. Under applied overhead means we did not apply enough compared to the actual cost we have. So in this blue highlight here, when a company applies less overhead to production, based on the estimates, than it actually incurs, this is the actual cost, it creates what's known as under applied overhead. Our estimates were off a little bit. We did not apply enough cost to production. Now, we did the best estimate we could, and hopefully we're very, very close on this, but you might have some under applied overhead. Now, opposite of this, we might have some over applied overhead. Maybe we applied too much overhead based on our estimates than what was actually incurred. If that happens, we have something called over applied overhead. So this under or over applied overhead that you're going to have for the year, we need to do something with it at the end of the year. We need to get rid of the overhead in that overhead account, the over or under applied, and do something with it. The simplest thing to do, if it's not a very material dollar amount, is just take it to cost of goods sold and just adjust cost of goods sold up or down, depending on what we need. So for example, in this highlight, the adjustment for under applied overhead increases cost of goods sold and decreases net operating income. So think about that. If we did not apply enough cost to production during the year, and at the end of the year, our actual overhead cost is more than what we estimated and applied, we need to add some more cost into the system because we incurred the cost. We have to do something with it. So usually we just go ahead and increase cost of goods sold, And what that will do, of course, is lower gross profit and then end up lowering net operating income a little bit. Now, that's okay because that's just the way the numbers work out. We're not adjusting anything that's not correct here. We just have to do this. Now, if we've applied too much overhead and we have over-applied overhead, then we take it to cost of goods sold and decrease that account, and that will end up increasing net operating income. So this is a way to settle things at the end of the year to make the numbers more accurate in the system. That's all we're doing here. This example is showing us that we had 6 jobs that we worked on during the month. Each job, A through F, has its own materials, its own labor, and its own overhead that was applied. So job A, we had $100 materials, 80 labor, 96 overhead. And so for each job, you have each one of these. At the end of the month, let's find out where these jobs ended up. It looks like jobs A and B we had not finished as of the end of the month. So all those costs stay in the work in process inventory account. Remember, these first 2 are inventory accounts. And the cost of goods sold, of course, is like an expense account in the balance sheet. But work in process at the end of any accounting period, end of the month, end of the quarter, end of the year, we have in this account the jobs are unfinished and the materials, labor, and overhead for each of those jobs. So these jobs we had not completed yet, the cost stays in work in process inventory. If we have a job that was completed and not sold yet, that cost, materials, labor, and overhead, the total amount, is in the finished goods inventory. It's already gone through work in process and now it's in finished goods. The cost stays here for completed jobs until we sell those jobs. So the only job that we completed and did not sell is job C. And so in our finished goods inventory account, we have $338, again representing the materials, labor, and overhead for job C, and job C only. Now it looks like we sold jobs D, E, and F, sold 3 of these. And so all the overhead cost, all the labor cost, all the materials cost for those jobs end up in the cost of goods sold account. They've already gone through work in process, finished goods, and now when you sell a job, the cost of that job is transferred to the cost of goods sold account. So this job for D, there's the 264, for E, the 444, and F, the 380. So our total cost of goods sold is $1,088. And again, this represents the cost of the jobs that we completed and sold this year. Back up to finished goods, this represents the cost of the job we completed but have not sold this year, or really, I should say this month. Work in process, these are the costs of the jobs that, for the jobs that we started working on and did not complete this year, the 498. Okay, next page. This is showing us that we don't only have to use job order costing in the manufacturing environment. In fact, most service companies use something similar to a job order cost system. Law firms, accounting firms, they keep up with how many hours the employees spend on that client. The client is a job. And so you keep up with the labor spent on that job, the hours, any other costs like legal forms, copying or whatever on that job. So job order costing is used in the service industry also. Even in a motion picture studio like Columbia Pictures, a film is a job. So you keep up with all those tens or hundreds of millions of dollars of cost involved in producing a film. The actors and actresses' salaries, directors' salaries, all the overhead, all the extras, all the special effects, all that goes into that one job. So, you can use a job for a film. A job can be a client in a law firm. A job can be a house being worked on. And a job can be a certain number of units out in the factory being worked on. So it's a very, very common cost system used by a variety of companies. Okay, it looks like we are at the end of the chapter. Make sure you read the chapter yourself closely, follow the numbers through again, read the summaries, and keep going through some review problems that are back here in the back of the book. So anyway, all right, that's it. So good luck with your studies.